Hey guys, Craig Levine, Ansley Real Estate. Hope you're having a fantastic day. Today I wanted to bring you some of the information that I gleaned from a recent seminar that I went to on the economic and real estate outlook for Atlanta for 2023. It was brought to us by the Atlanta Association of Realtors and the Atlanta Business Chronicle, and it featured the chief economist for the National Association of Realtors, Lawrence Yun. So without further ado, let's dive into this. So on this chart, we're looking at the existing home sales percent change from a year ago. And if we go back to the 2019 year, you can see that not much was going on pre-COVID. It was pretty much flat. We get into COVID in the beginning of 2020, and we can see that real estate sales just totally drop off the charts until May of that year, when all of that pent-up demand that had been brewing to get out and buy something, to get out of your, small house or whatever and get into a larger house. People who were renting small apartments wanting to get into a house now. They're working from home and they need more space. All of a sudden, you see the existing home sales just fly off the charts. All of 2020, the latter parts of 2020 actually, and then 2021 was just such a banner year. I mean, home sales were through the roof. And then, of course, you can look at the impact from the high mortgage rates starting the beginning of 2022. Things, are starting to, slow down a little bit, and then second quarter, they slow down even more. Third quarter, things start dropping as far as sales go, and you start wondering what's going on. And then the fourth quarter, everything just grinds to a halt, mainly because of the rise in interest rates. Okay, our next slide. The annual existing home sales, these are down 18% in 2022, and they're the lowest that they've been since about 2014. You can see here's the 2022 level, 2014 about the same. And, the home sales had been rising in 2018, 2019, 2020, and 2021 was such a stellar year. And then boom, with interest rates going up to 7% at a time, it just really killed off home sales in 2022. So here we're looking at new construction versus existing home sale pricing. And you can see that new home construction in red and existing construction in blue. The new home construction, of course, is generally more expensive than resale. And that's pretty much just due to the cost of materials, the cost of labor. Nowadays is generally more than it used to be. But throughout time, you can see that prices are generally increasing here. So here we're looking at the market brief from November of 2022. You can see here that total sales are almost 4,000. The active listings are 12,358. The average price is $460,000. New listings are about 5,000. We've got a 2.1 month of supply, which is definitely a bit more than we've had previously over the course of 2021 and 2022, the beginning portion of, at least. And the median home sale price is $390,000. And this is for November of 2022. Again, from November of 2022, that total monthly sales are about 4,000. That's a decrease of 39.8% from the year before. It's a big, big drop. So on this slide, we're looking at the median home sale prices in Atlanta, Sandy Springs, Marietta, metro area. And this goes back to 2000. And you can see back in 2000, you could buy a house in Atlanta for $125,000. I mean, shoot, that's amazing. We should have bought a whole bunch more back then and built up a portfolio. But you can see home prices generally rise over time until we hit the Great Recession of 2008. and all the foreclosures and short sales, that brought the market back down substantially. Wow, you could buy some more homes. I mean, look at that. Back in 2012 or so, the median home sale price was under $100,000 in Atlanta. Oh my God. Then, of course, we start recovering, and home prices go back on up. They're generally highest, of course, in spring and summer when you have the most people looking. There are the most properties on the market. And they tail off in the winter months because people just don't want to be buying homes during school season for the most part. But I mean, these home prices keep going on up, and then 2021, oh my goodness, look at this. It's just like crazy. Demand is at almost an all-time high, and supply is at almost an all-time low. So, due to the laws of economics, these home prices are just like shooting through the roof. And then what we see here towards the end of 2022 is a little tail off. That's not typical. So quarter one, quarter two of 2023, we'll see where things are heading. Are housing prices going to crash? The big question. Well, let's take a look at the chart over here. We've got some key variables. We have what happened in the last housing cycle back during the Great Recession. And then we have current housing cycle, what's going on today. Job cuts, these are net gains and losses. During the Great Recession, we lost 8 million jobs. Today, none. Of course, people are being laid off from the big corporations right now, but then you've got a lot of people that are getting new jobs. The market is really strong for jobs right now. We had 130 million salaried employees back during the Great Recession. Today we have 153 million, a lot more. These are total jobs, including people who are self-employed. We had 138 million. Then we've got 158 million now. Subprime loans. These were one of the big reasons for the Great Recession. They were giving these loans out to everybody, anybody with a heartbeat. No income verification, no credit verification. It's just crazy. That was prevalent in that day. Today, there's virtually no subprime lending going on. So it's a lot more stable lending market right now. The 5-year cumulative to new home construction before the crash, we had 7.65 million homes. Okay, this was cumulative new construction, 7.65 million homes being constructed. Okay, today it's 4.6 million. There are so many fewer homes being constructed today. So there's not an oversupply, there's an overdemand for housing right now. And we're just not building enough homes right now. The inventory on the market, we had 3.8 to 4 million homes on the market. Today we've got 1 to 1.2 million. Again, supply is at, all-time low. Mortgage delinquencies. 10% of mortgages out there were delinquent and possibly facing foreclosure. Today, we've got about 3.6% of mortgages are delinquent, but not necessarily facing foreclosure. Homes in foreclosure, we had 4.6%. Today, we've got 0.6%. So it doesn't appear when looking at these statistics that there's a major crash coming. You may hear some scratching in the background. That's my doggies getting a little impatient, so sorry about that. But this chart talks about mortgage delinquencies, which are 90 days or more in arrears. And you can see through time, going back to 2000, it averaged about 2%. And then, of course, with the Great Recession, it went on up to almost 10%, then came back on down. And then when the pandemic hit, a lot of people stopped paying their mortgage, at least for a while there were plans in place that the forbearance plans that were going on, which allowed people to, forego paying their mortgage for, sometimes as long as 16 months. It was amazing. So you had a lot of people here that were at least 90 days past due, not necessarily going into foreclosure though. And then, of course, as the economy started getting better and people were able to get back out and start working again, that rate dropped. Here again, we're looking at the percent of total sales that were distressed. And back in 2010, they were about 1/3 of every sale in the market was a distressed sale, whether it be a foreclosure or whether it be a short sale, where people would have to go back to their lender and try and sell their home for less than they owed on their mortgages. And these were just, they were the name of the game back then. And if you weren't doing short sales, you weren't making money in real estate. And then even if you were, you still weren't making money in real estate unless you were selling foreclosures. And so these died off, about 2013, 2014 or so. And as you can see today, they're just a really small, minimal amount of the total sales in the marketplace. So here we have inventory of homes on the market. Of course, you can see back here, 2005, 2008, there were just a large number of homes on the market. Builders were just building like crazy. And in 2020, 2021, 22, the inventory is super tight right now. So, are home prices going to go up or down 5, 10%? Maybe. But they're not going to drop precipitously just because there are such a shortage of homes on the market. The supply is ultra tight, demand is still out there. So, especially in Atlanta, we just don't see the market dropping more than maybe 5% or so. So this is a very interesting chart here. It shows the housing asset and mortgage debt. The blue line is actually the total collateral of housing value in America. And the red line is the total mortgage debt. You see the blue line rising and the red line rising back in the mid-2000s or so. And housing value was fueled essentially by mortgage debt. And what you see between them is total wealth, real estate-wise. During the build-up to the Great Recession, home prices just kept rising and rising and rising. And you see mortgage debt, steadily increasing, but not going crazily. The Great Recession comes along and house values drop, total collateral value drops. And then what we see here is pretty much just a steady, slow increase in mortgage debt. Nothing crazy, nothing substantial. But look at these home values. Home values are going up substantially. And this is fueled by supply and demand. Not so much mortgage debt over here, because mortgage debt is just marginally increasing. But it's amazing today in the media, you hear everybody saying, we're at an all-time high of mortgage debt. But little are they conveying to you that home prices are also at an all-time high as well. Look at this gap over here, the wealth gap over here. It's just, sometimes the media just blows things out of proportion and, don't listen to everything that you hear on the news because they're just trying to get ratings. We've got the long-term single-family housing starts. And historically, starts have averaged about 1 million per year. And these are new construction single-family housing starts, going back to 1960. And as we can see, they go up, they go down, but they're generally about 1 million per year. Come the Great Recession and slightly beforehand, we see this huge dip in new construction housing starts. Nobody wants to build in a foreclosure market for the most part, of course. And we have not recovered. We have still not recovered. That's why there's such a housing shortage to this day, is because we're not building enough homes. Now we're looking at multifamily housing starts. Historically, and this is a little wrong here, there have been an average of about 375,000 units built per year. And this is going back to 1960. And you can see there have been, years that we've built far more than that, and some years that we've built far less. But multifamily is definitely starting to kick back up. We're starting to see a whole lot more apartment complexes being built. And if you look around Atlanta, you see them popping up all over the place. So let's look at rent growth for these apartments. Back in 2019, there was slight rental growth, but 2021 comes around and man, rental growth just blows off the charts. I mean, rental growth is, 12-13% that year. 2022, there's still rental growth. There's still apartments being built, but we're starting to see potentially rental growth dying off a bit in 2023. And then who knows what to expect in 2024. If you're in the rental business and you have investment property where you rent out to tenants, we may be starting to see a slowdown in rental growth due to the abundance of these apartments being constructed and oversupply eventually taking hold. In weeks past, there had been some hopeful signs on mortgage rates dropping a little bit. Since then, rates are starting to tick back up a little bit due to positive economic signs and the Fed feeling the need to keep increasing the federal funds rate in order to stave off inflation. Back in October of 2022, mortgage rates reached the highest level in 20 years. They got back above 7%. Everybody's gotten used to these 3%, 30-year fixed rates and everything. And so, young buyers don't recollect these 7, 8, 9% interest rates that I've dealt with during the course of my real estate career. But these rates did drop from October, the high. They did reach about a little over 6%, and now they're starting to trend back up a little bit. And we're being told that the Fed may continue increasing rates for the duration of this year still. This chart here shows the 30-year fixed-rate mortgage since 2000, and we can trace that up until about present day. And it also shows the 10-year Treasury bond rate. And we can see that these generally will coincide with each other for the most part. And the difference between the two is called the spread. And what we're seeing here is that there's definitely a larger spread than typically had existed in the past. And I'll take you to the next slide here. The spread averaged about 1.7% or 170 basis points traditionally. But in February of 2023, the spread was 240 basis points or 2.4%. So there's definitely got to be downward pressure, because when it goes up, it comes back down, and it generally averages out to 170 basis points or 1.7%. So at 2.4%, there's definitely pressure on this interest rate, the mortgage rate, to drop. Here we're looking at wage gain versus the consumer price gain. And what we're seeing is wage gain in orange, and we go back to 2019, and wage gain is ticking along, goes up substantially in March of 2020, and comes back down, and then it reaches a low point here in March of 2021, and it continues to go up a good bit. But let's look at the consumer price gain in blue over here, and this is pretty much showing us that since May of 2020, when the economy started opening back up slightly, after everybody's been, stuck in homes for a couple of months, we see the consumer price gain. People are out there buying again. Everything starts ticking up in price. We see inflation happening. And inflation just keeps on going. And then if you look at the gap between the consumer price gain and the wage gain, you see that wages, they're sort of stagnant. And you see consumer price gain or inflation continuing. And it has come down slightly since mid-2022, since the Fed started raising interest rates to stave off inflation. We also see the wage gains start dipping as well. So this map is pretty interesting. It shows the number of payroll additions or people employed from pre-COVID days up until December 2022. So we're looking at the percent gain or loss in the number of people that have been added to payrolls. And so the dark blue and the blues represent positive gains. And you can see states like Texas, Florida, Idaho, Utah, Colorado, and of course, Georgia, they're doing very well. They're recovering. There are 4.4% more people employed now than there were pre-COVID. These states have recovered. They're doing very well. Now, the states in peach or orange or red, they still have not recovered from COVID. It's very interesting to see which states are doing well. And Georgia pretty much was the first state in the nation to reopen during the pandemic. You can see it's resulted in some positive economic results. Let's look at payroll jobs in Atlanta Metro. And Atlanta's just such a strong economy. It has been for a number of years. We go back to 2000, and we have about 2.3 million people in the workforce back then. And this is going up steadily over the course of a number of years. And then once it hits like 2010 or so, it just really starts taking off. And it's just gangbusters, of course, up until the pandemic where it tails off a bit. But since then, it's just been going like gangbusters again. And we're at over 3 million people in the workforce right now. That's about 700,000 people more than we had back in 2000. So, you wonder why we have these traffic jams and tie-ups and everything. That's definitely one of the reasons. But there is a strong workforce, and they're not building any more land. So there's a lot more people needing to be housed, and that's why the demand is so strong and supply is definitely limited in the Atlanta marketplace. They're just not building enough homes right now. So let's look at the national office vacancy rates. And of course, with the pandemic, people are just not going into the office. They wanted to work from home. Although they are starting to go back to the office, there are still a lot of workers that are working remotely, and this has affected the office vacancy rates, and it's not good for expensive markets like New York, San Francisco, Washington, D.C. You have some of these workers saying if they can work remotely, hey, why not move to a more affordable area like Atlanta? That's why this may benefit Atlanta in the long run, because you're going to have people moving from more expensive markets to Atlanta and more affordable markets. So there's going to be even more demand for housing in the years to come. Here we're looking at the federal outlay, the blue bars, and the tax receipts, which is the orange line. We can see as we go along, we are starting to spend more than the government is collecting. This continues, and it's really gotten out of hand in the last couple of years. Here is our spending, and here's what we're collecting, which is definitely resulting in a growing national deficit. And we can see here from 1990 going into the Great Recession, starts going up, and it continues at an even higher clip in the last couple of years. The deficit's just reaching astronomical portions. We're already over $30 trillion in national debt. The mortgage rate forecast, everybody wants to know where are rates going, what's going to happen. Of course, they started ticking on up in 2022. They started coming back down slightly in 23, but we don't know where rates are going to go. And, especially with these good economic forecasts and data that are coming in recently that are going to essentially make the Fed continue to raise interest rates to stave off, more inflation. This is speculation, but you can pretty much assume that rates are never going to be back to the 3%, potentially 4% area in the next several years. We're probably setting in for a time of 5 to 7% interest rates. If we get down to 5%, it's great. Go for it. So we're looking at the home sales forecast for new and existing homes, and this is nationally. And what we're seeing is that 2021, it was just a bang-up year. It was incredible. 2022, we start seeing a decline in the number of home sales. In 2023, all in all, is looking like it's going to be a relatively flat year. And what we can see here from our charts, the forecast in number of sales is going to be off by about 7%. Home prices are probably going to be relatively stable. The dollar volume should go down by about 7%. But what we see here in 2024 is that the market should rebound. Sales should increase by about 10%. Home prices about 5%, and then dollar volume by about 15%. So 2023 is going to be a year to just weather. Definitely don't foresee Atlanta being affected as much as some of the other areas of the country. We've got strong demand. We've got limited supply. And so if you're looking to sell, you'll probably get what you want for your house, minus 1% or 2%. If you're looking to buy, you may be able to negotiate a little bit better deal. Look into these buy downs may help you make a house more affordable. These builders are offering 2-1 buy downs where they will buy down the rate in the first year by 2%. In the second year, it will be by 1%. And then in the third year, it will be at the predefined rate as well. But that makes it more affordable for buyers to get into homes with interest rates in the 6-7% zone right now. So all in all, Atlanta's looking positive. We've got strong demand. We've got limited supply. It's one of the most affordable places to live in the nation. We've got an influx of people moving from all over the place. Definitely foresee Atlanta to be one of the most stable places in the nation to buy or sell a home in the near future. But if you're looking to wait for these interest rates to come back down to 3%, 4%, probably not going to happen. So don't count your horses. Go ahead, give me an upper ring. Let me help you buy or sell a home today. Thanks so much. Appreciate your time and for listening to this presentation. Always feel free to leave comments down below. If you thought this video was useful, please give us a big thumbs up and definitely subscribe to our channel so that you're notified of all the best deals in Atlanta when they hit the market, and we'll keep you appraised of things happening in the metro Atlanta area. Until next time, take care.